Look, if there's one thing that I really hate about investing, it has nothing to do with the stock market itself, but rather the influencers and the people that talk about the market. You see, these people try to make investing sound super tricky, and usually it's because their end goal is to promote either their stock buying courses or a paywall to their portfolios. They highlight specific individual investments, which I think is never the correct strategy for beginning investors. And oftentimes I've noted that their results are super subpar, and they only highlight their winners and they don't shed light on the losers. They just sweep them under the rug. But beginning investors then come in, they get discouraged by the results that they're seeing, and they think that there's no hope for them in the stock market. They then turn away from the stock market altogether and lose out on tons of gains that if they just started investing the right way, that they'd be able to capitalize on throughout their life. But what if I told you that there is a much simpler way to go about all this? One that you're nearly guaranteed to become a multi-millionaire by the time you retire. It's not only got a proven track record historically, but it's the exact method that I use and I've seen some of my best results investing from. Now I'm gonna break it all down in this video here for you today, not behind a paywall. You don't need to pay anything to me for this. Let's just jump right in. Now this all started with Jack Bogle, who is the founder of the Vanguard Group, and he really pioneered the field of passive investing. He emphasized both the importance of keeping investment strategies simple, low cost, and efficient, which perfectly aligns with the principles of this method we're going to talk about. So let's take a closer look at this method. It's actually called the Boglehead Lazy 3-Fund Portfolio, and this portfolio is all about simplicity, efficiency. It's incredibly easy to set up and manage. And the reason why I love it so much is because I'm the type of person that honestly gets really stressed about money. I hate losing money, and I want to set up a portfolio that I'm able to leave my money in the market, set it, forget it, not going to lose sleep over it. And that's exactly what this method does for you. So what are the 3 magical funds and why are they so powerful? Well, the first fund in the trifecta is the Total Stock Market Index Fund. Now this fund gives you exposure to the entire US stock market, from large cap companies like Apple and Microsoft to small companies that are just getting started. And by investing in a fund like this, you're essentially buying a slice of the entire American economy. And I talked about historical data, and the reason why this one does so well is because over the long term, the US stock market has delivered, impressive returns, averaging around 7% to 8% annually after adjusting for even inflation. And because this fund is passively managed, the fees are actually incredibly low, allowing you to keep more of your hard-earned money working for you. The second fund that we have in this portfolio is the Total International Stock Market Index Fund. Now, while the US stock market is vast, there's actually a whole world of investment opportunities that are beyond our borders. So this fund, it actually invests in companies that are located outside of the United States, and it just provides an extra layer of diversification and exposure to different economies and industries. And here's the thing, international stocks have historically exhibited low correlation with US stocks, meaning they don't always move in tandem. This can help reduce the overall volatility of your portfolio, and it's going to smooth out your returns over time. And just like its domestic counterpart, the fund boasts rock bottom fees, keeping more money in your pocket. And last but certainly not least, we actually have the Total Bond Market Index Fund. And while stocks grab all of the headlines, bonds play a crucial role in the development of a well-balanced portfolio. Bonds are essentially loans that you make to the government or corporations, and in return, they pay you interest. And bonds are really less volatile than the stocks, and they provide a steady stream of income, making them an excellent counterbalance to challenge the ups and downs of the stock market. Plus, in the times of market turmoil, when we have really negative stock market, investors look to bonds, driving up their prices, and it provides more of a cushion for your portfolio. And so you can go absolutely nuts with investments, with individual companies that you think are going to do really well. But you look at Tesla, for example, which people pump, get a ton of value behind it, and then it tanks, and a lot of people end up losing a lot of money on something like that. Well, this portfolio is very diversified, and it's designed to weather pretty much any storm that you have and grow really well over time. Don't just take my word for it though. This is the M1 Finance app, my Roth IRA in here. You can see Vanguard's total stock market index has $8,172 with a 27% return. So off of about $6,000 being invested into it, I've returned $2,000, up nearly 30%, which which is like super solid for the stock market. And listen, I get it, because when I first started investing too, I mean, I could not see the end results of what I was doing. I couldn't imagine how I could turn a little amount of money into, you know, tens of $1,000s without basically gambling on individual companies, doing risky strategies that just honestly made no sense. I wasn't thinking through what I was doing clearly. And so here's a screenshot of my Robinhood portfolio where I started investing $5 every single day into Vanguard's total stock market index just over a year ago. And you could see off of the small amount of money that I've invested, I've already returned positive $345. I'm up nearly 23% in this portfolio. And again, it's just been a little bit over a year now. Okay, so I didn't really talk about bonds or international funds in those portfolios. I do have exposure in other portfolios, but now this is what is most important about this strategy, especially for those beginning investors. I think the early days are the most influential about how you're going to handle investing in the future. If you end up losing a ton of money really fast, obviously you're going to be discouraged and you're not really going to want to invest. This strategy offers a crutch. You're not going to get these insane results either way. You're not going to make a ton of money super fast, but you're also not really going to lose a lot of money super fast. Now, again, it kind of traces the market, so how that acts is going to impact your portfolio. But at the same time, it gives you this crutch that allows you to figure out more about yourself. You can learn your investment profile, what you're comfortable with in terms of risk exposure, and like watching the fluctuations of the market and really just learning the principles of investing. And what I find crazy is you talk to some of these really wealthy people, these seasoned veterans at investing and these professionals, and they take strategies just like this and copy them and use them for their own. And so like, that's what kind of blows my mind, is that we've got all these young people who come into the market and think that they've had it all figured out and know exactly what to do, when in reality, it's super difficult to actually nail it down. Because if it was as easy as that, well, then they'd probably have millions of dollars more than they actually have. And, you know, you can kind of see where I'm going with that. The other thing is, you never just want to blindly copy anybody online. Even myself, like, do your due diligence, research everything that I talk about in all my videos, and make sure you're fully comfortable with some of the investments that you're going to be making. And then what's really crazy for me is the benchmark for investors is to always outperform the market. If you're not outperforming the market, you go back to the basics and all you do is you invest in the market. And that is the principle of investing. That is just simply the rules of what you're trying to do with your investments. You're trying to grow, beat inflation, put your money to work for you, and ultimately beat the market if you can, but most people can't. And the best strategy is then to rely on the performance of the market. So let's just look at this quick scenario. Now that you know you should be at least on pace with the market, well, if you started investing at 18 with $0 to your name, but you were able to invest $5,000 a year, that's just $400 a month. Most of us spend more money than that out eating food and whatnot, but you would have invested in 47 years, from 18 to 65 when you retire. You would have invested $235,000. That money would accumulate and grow by over $2.2 million, and you would finish with $2.45 million. So with that clear path of investing in front of you, it just blows my mind that a lot of people overthink it and they're going to get discouraged. And like, this is just a lot of the stuff that I want to get out there. It's so much easier than it's made out to be. Anyways, guys, if you enjoyed the video, please leave it a like, hit that subscribe button if you want to see more content just like this. Thank you so much for checking it out, and have a great day.